What's going on, guys? My name is Lucci. I'm here with Haim Bodek, our resident algorithmic arms dealer. And today we're going to talk about fragmentation. So Haim, what the hell is fragmentation?
Well, I think one of the easiest ways to explain it is that it is the fact that there are 13 stock exchanges and over 40 dark pools, or places where you can execute off exchange. And that has created a stock market that most people can't really wrap their mind around.
Indeed.
Okay, so when we talk about fragmentation, we have basically three clusters. The first cluster would be the exchange space. So there's 13 of those.
Okay, so we have 13 exchanges.
Yep. And we have approximately 40 dark pools and
40 dark
alternative trading facilities. Okay. And we also have this kind of, opaque word, internalization. And what that is a off-exchange venue where a market maker can trade against order flow without subjecting it to any competition on the market. And that's also, needs to be on this list.
So what is that?
We can just call it internalization.
Internalization.
Right? So when you trade a stock, your stock is, your order is going to one of these locations.
Okay.
And usually you don't, as a retail customer, you usually don't have much control over that or much transparency into how that process works.
So meaning, if I was a customer sending an order, I don't know where I don't know where in this pool it gets routed to, or it gets executed off of.
Yep. And now we're going to get we can talk very briefly about one of the things a retail customer is going to be exposed to, and it's called payment for order flow.
Right.
Well, what happens is these internalizers over here, which are otherwise known, often called market makers, but they're not the kind of market maker that's in the screen in a continuous basis. These are guys who conduct most of their business off exchange. What they're going to do is buy your order from your broker.
Okay.
They're going to decide whether or not they want to trade it. I sometimes call that cherry picking. And then they're going to decide if they didn't want to trade it, well, maybe there's a dark pool they can trade it in, and they might do that because it's cheap to trade in a dark pool, and they still have to get your order done. Or they might send your order down to the exchanges. So the whole path that you're taking, is going to be quite complex across this heavily fragmented universe.
So if I'm a customer, right, and my broker, let's say, is involved in payment for order flow or internalization, how does that negatively impact my order flow, right? So how does it, let's say I just want to buy 10 contracts of X, Y, and Z option. How does this negatively impact my fills or my order flow or anything like that?
Well, one thing I wanted to emphasize here is there's a huge difference between internalization and options and stocks. So
Okay.
we're going to bring it to stocks.
Let's bring the stocks
for this one. Well, interestingly, internalization can be a good thing and can be a bad thing. Your order could be provided price improvement and you get a better price than what you could have gotten on the market.
Okay.
Or your order can be held up and in some cases maybe even traded at a price that would be impermissible by regulations. So what this really is doing is creating more uncertainty and variability in your execution quality versus if there was just one exchange where everybody's orders.
Where everybody could order to. Cool.
Yeah.
So the other question is that the retail or anybody who's involved in this internalization and they're buying the payment for or they're buying that order flow, what are the entities that are actually paying for retail order flow from, let's say, any trade or a Scottrade or any of these retail platforms out there?
Well, you have
who would be interested in that information?
Some of the big guys out there. You may have heard of Knight Capital, which is one of the big guys in the space. We also have Citadel, and we have UBS.
Right.
And there's quite a number of firms that do this.
And what's the advantage for them to pay for that order flow?
Well, this has to do with this concept of discrimination or cherry picking. okay? They're buying the fact that you're sending a dumb order.
Right. Right.
Okay, so typically, and quite literally, these guys might have different deals. They're like, I'm going to pay this for market orders. I just want your market orders.
Right.
Okay, they're going to be quite sensitive about how large your the trades are that they're buying, and the other, and and also they'll be looking for how informed. They can literally measure how informed these trades are. So really, if you're, if they're buying your order,
right,
that's kind of a sign that you might be giving up a little bit too much edge in the way that you're trading,
right,
or your broker might be,
right.
So the highly informed or very well executed orders, these guys don't want to trade with at all.
Right. All right, so to summarize, and actually we're going to go do a couple parts of this one, because this one is very interesting to me and also pertains to a lot of you retail traders out there. So there's a lot of advantages that, some of the bigger players out there, some of the hedge funds, UBS, Knight, and all these different market makers, they get from buying your order flow from, any of the retail platforms that you guys use. So we're gonna come back to this topic soon. Thanks everybody for joining. You'll see you soon.